While thinking of purchasing a property, many people often confuse between pre-qualification and pre-approval. Pre-qualification would be the initial stage where a lender or a mortgage broker will assess your mortgage affordability. Whereas in pre-approval, mortgage agent or a lender will provide you the rate after your credit pull. Today we are going to have a virtual podcast with my manager Matthew Shantz, where we will discuss everything related to pre-approval. This is going to be so much informative, so watch the video till the end. If you are new to this channel, I am Rahul Kota. I am a mortgage agent here in Ontario. I work with DLC funding. I specialize in first-time home buyers. If you are someone who is thinking of buying a property, even 6 months from now or even after 1 year, feel free to book a call from the link in the description. With no further ado, let's dive into the podcast.
I'm just going to record a conversation and then I'll just give you the whole file, and because there's going to be some gold in this anyways, right? That you can maybe use, right? But clients can be really weird about that, and not in a bad way, but in the way that, they will hit you with almost an unexpected down the road, right? Where you think they're gonna go one path, like, oh, they end up with their bank, they got a better rate, I didn't do what I was hoping, I didn't achieve my goals, and then all of a sudden they're like, but your service was so good that I think you need to help my friend here, right? And you get that real flip around. And so, it's so important that everyone we talk to, we treat like gold, right? Even if I'm pissed, even if I'm mad, even if I'm grumpy that I didn't get paid on this deal, there's still value that's going to come. One, you practiced, you're able to practice the file, you're able to practice the deal, you're able to practice the transaction, you're able to go through documents, you're able to shop lenders, right? Every deal we practice makes us better, right? Two, you faced rejection, right? And you dealt with it. Facing rejection is hard, right? And you only get better at it the more you have to face it, right? And, that's why these early days in brokering is so important, to be out there hustling and getting all the no's and all the doors slammed in your face and all that negativity thrown at you, because you're going to find out if you can make it or not. And if you can't take the no's, you probably weren't made for sales. And it's funny, the reason
That's why I am not trying to give it up. Like I'm just like keeping in touch with him.
And it's funny, where most people give up is only a few days or weeks or months before they make it. Most people give up right as they're about to make it, because on the other side of your break point is typically success.
Yeah.
Right. When you go, I've had enough, I'm exhausted, right? Well, that is where most people stop. If you can push right through, success normally lies right there, right? It's like you don't make muscle in the gym without hurting, right? Lifting weights, if it didn't hurt, if it was easy, you're not going to make any muscle, right? But if you actually work and you hurt and you feel like puking, you're going to see some results from it, right? And it's the same way in selling. It's the same way in client management, in being an entrepreneur, in owning a business, and anything, right? Unless you're ready to throw up, you really haven't worked yet, and even today, like, I was laughing a bit, but I'm already, it's Thursday, I'm already at 50 some odd hours behind my desk this week,
50 hours,
50 plus hours easily. I've put in 3 back-to-back 15-hour days. It's like,
you told on Monday, like you were sitting since morning.
Yeah, exactly. And it's one of those things, like, but and it doesn't matter where you're at in your career, right? There will be times where you have to push super hard to get your successes and to get to that next level that you're trying to get to, right? I'm trying to get to a new level in my business and my understanding. Well, unfortunately, it's a big, heavy weight to start lifting to get there, right? And so it's one of those things where, you never want to, the bad stuff, the no's, the rejections, all this stuff is good. most people just don't understand it. Most people won't push through it, right? Most people had it too easy in life, where they had a lot of yeses real early in their life, right? And didn't have to face the no's, right? What you're gonna find is that if you do the job well, treat people well, treat clients well, it's gonna quickly snap into a whole bunch of yeses, one after the other, right? And I'm excited to see it. And I know you're swimming kind of in a pool filled with potential deals right now, right? And that's exciting, right? The trick will be converting them, right? The trick will be getting them into pipelines, turning maybes into yeses, turning I don't knows into yeses, right? But that is a whole skill on its own, right? And in this stage of the game, that's going to practice a little bit, right? How do I turn a maybe into a yes, right? How do I convince somebody to take a chance on me, right? There's three general ways to do it, right? Number one is to be referred, right? Referrals are one of the fastest, easiest ways to turn maybes into yeses, right? Hey, listen, I know you're hunting for a house. Your realtor and I work together. He would like you and I to work together, right? So that third party connection, right? That intermediate person who can bridge the gap, right? That's one of the easiest ways to take someone who's out there as a maybe into a yes, right? That's why I like to work within my referral network generally, right? The second way to turn a maybe into a yes is a recommendation, a review, right? What's the one thing that makes us pick one restaurant over the other? We check the rating, we check the reviews, right? We check what other people are saying, right? What their experiences look like, their pictures, right? This is hard when you're early in your business because you don't have a lot of that yet. But what you can get people to make personal reviews about you. You can get people to talk about you as the individual, right? You can get testimonials about, what kind of person you are, how you treat others, the way you approach business, right? So until you have reviews, get testimonials, right? And state it as testimonial, right? Don't call it a review, call it a testimonial. Let people know, like, this is not someone I've closed a deal with, but this is someone I've worked with or someone I've encountered, right? And use that. The third way to convince people is through education. I can educate you into a yes, right? And this is something that you have sort of created a bit of a reputation for already, is you want to work with me based on this knowledge base. Please go follow these resources, see if I interest you, if I bring value, right? And do you want to work with me because of that and clinging on to the value, right? So you shouldn't be shy when you meet a client to actually go, hey, listen, it's a real pleasure to meet you. While you're waiting to talk to me, here's my content, right? This is something I've taken into my recruiting recently, right? I've done a few podcasts with people. I've got some video out there. I've got some content out there talking about becoming a mortgage agent, right? Now when I'm out recruiting mortgage agents, I include that content in my reach out message. Hey, listen, I would love if you considered me as to mentor you while becoming a mortgage agent. Here's some of the conversations I've had in the past while you think about talking to me, right? And so actually leading proactively with your content is not a bad way to approach people. Hey, listen, while you're making up the decision between the bank and I want you to hear some of the things that I've taught people in my networks before, right? And come at it with the educator side, right? Because you've got some great difference makers that will separate you from other agents, from other brokerages, from other branches and lending sources and people in the business, right? So take your special and throw it up front, right? This is what people say about me. This is what I've been saying, right? This is the people I work with and what they, and use those three tools to convert the business around you into your pipeline, right?
For the starters, it is first education, referral, and review. Like for those who don't have the experience.
Yeah.
First
So
educate, then expect the referrals.
exactly, educate, referrals, reviews. Those are your three magic tools to converting business, right? And it's never going to be Raul's got the best interest rate, right? I expect you to come with one of the best interest rates. You're in one of the largest brokerages in the country. You have access to tons of lenders, massive amounts of volume going through. Good interest rate. You'll be better than market with your interest rates that you start with, right? So knowing that interest rate's not the defining factor, what is it that makes someone want to work with you, right? And really focus on that. Sure, there are some businesses out there are some agents out there that all they have is rate.
Right. The lowest,
All they can,
cheapest rate.
yeah, all they can lead with is best rate, best rate, best rate, and that's fine. But there's a very important part that everyone forgets. They don't have all the business, and there's a reason why they don't do all the business. Because if rate was all that mattered, then the cheapest would always be the best. And it's not. Do they do a lot of business? Sure. Because for some people, it is the most important thing, and that's fine. Go work with them. But if you want someone that's going to educate you, that's going to connect you, that's going to provide you with resources and tools and help you succeed and keep on plan, you're going to pay a little bit of a premium. It's still going to be cheaper than somebody that has no resources and no volumes and no support, right? Because there are the boutique brokerages out there that have 10 agents and do no volume and don't have access to the best rates, right? And then there's the flip side where you've got all the good, but you have the ability to be boutique service. Okay. But yeah, that's my rant on that bit. I know there was more like question-based stuff that you wanted to talk about today.
Actually, yes. I wanted to talk about like everything related to pre-approvals. Like most people just confuse in between many things, like what exactly, like what they have to do. Everyone knows, okay, pre-approval is the amount, like what they are exactly getting and what the rate they are getting. But I wanted to ask few more detailed questions in this. So I want to start with the basic one. Like everyone like things like pre-approval, like many people are often confusing between pre-approval and pre-qualification. So what exactly, like how exactly you want to define that one?
Yeah, and it's funny because this is a similar situation to when people hear variable rates and then find out there's variable rates and adjustable rates.
Yes.
And what it is that there is what we consider a blanket term. It kind of covers the whole category, and then there's specific terms within it, right? So everything's a pre-approval when you're talking with a client, right? There's no differentiator in a client's mind between a pre-approval and a pre-qualification. Everything's a pre-approval. Same thing with clients when we're thinking fluctuating interest rates, everything's a variable rate mortgage. Doesn't matter if it's adjustable or variable behind the scenes, right? And so knowing the client term is really important. Now, from a technical term, a pre-approval is a fully underwritten deal minus the property. Okay. We have verified income, down payment, identification, pulled credit, reviewed credit. We have everything here except a subject property, right? We're ready to go, right? But no subject property. Okay.
The subject property will be in the later stages, like during
Exactly.
the.
That's so all pre-approvals are contingent on approval of the property. Because if it's a bad property, it could kill your deal, right? So not a pre-approval is not a guaranteed deal because it's the subject property matters. Okay. A pre-qualification is typically you telling me how much you earn minus some debt load, me shooting you a number, right? So Raul, you make $100,000 a year, you don't have any outside debt. Today we would take that and multiply it by 3.9. You can qualify for about $390,000 of mortgage, give or take a little bit, right? It's an estimate. A pre-qualification is more of an estimate, right? I haven't gone through and actually qualified your information yet. It's if you ask me, you know, hey, what's the best interest rate? What's the best this? What's the best that? I'm just pulling it out of my head from what I'm aware of, right? Yes, I might do some calculation to narrow it down a bit better.
Many people, like people I talk to, like they expect like to give the final rate at the time of pre-qualification, and many people like just go away because like okay, we are getting the lower rates over there, and they don't understand the difference between pre-qualification and pre-approvals.
And here's the trick. Neither of them have anything to do with interest rates.
Yeah.
Because there's a third topic called a rate hold. And neither of these things on their own are a rate hold.
Mhm.
A rate hold is that now I've taken your pre-approval, I've submitted it to a lender, and they're going to hold an interest rate for a period of time for us. And the interest rate they hold is typically higher than market rate. So if I came back and said, you know, you came to me today and said, hey, Matt, I want to get a mortgage from you. And I go, great. If you're qualified for an insured mortgage, 25-year M, 5% down, that type of thing, I'm going to happily offer you 4.69. Okay. If you came and said, Matt, I need a rate hold for all that same thing, I'm probably going to offer you an interest rate at about a 4.84. Because the lenders will typically create a slight buffer for allowing interest rates to increase, right? Not by much, but a little bit, right? And then when the deal goes live, you'll get the best rate at that time, okay? But no higher than what was put on the pre-approval, okay? So what people really want is they want a pre-approval plus rate hold, right? That's not super relevant in a decreasing interest rate market.
Mhm.
Right. There's no point for me to go waste an underwriter's time with issuing a rate hold in a market where we know rates are on a
It's
downward
going
trend.
down.
If we were seeing any indication of an upward tick in interest rates, we would 100% lock in and do rate holds, right?
Right.
Can I give you a range as far as what your interest rate is going to be? Sure. Absolutely. I know that the cheapest rate on the market today is 4.49. I'm not probably going to put you in that. There's a lot of strings attached and things that I don't want to, that we wouldn't sell normally, right? My standard low rate today, 4.69, right? That makes more sense on where to put somebody, right? The market standard is 4.89, right? So, you know, the same deal, depending on the lender and the policies and the product, right, could have many different interest rates available. The key point is finding you the most suitable lender to match your needs, right? So we aren't lender selecting in the pre-approval stage. We might narrow it down to 3 or 4 lenders, but I haven't actually picked one yet for you because the property is going to matter, right? I'm going to have to assess your suitabilities, right? What's happening in your life over the next 3, 4, 5 years? Are you on an upward trend for earnings? Are you on a downward trend towards retirement? Are you expecting a child in the next year or two? Are you getting married? Are you getting divorced? Are you retiring? What's going on, right? Matters when we determining, you know, debt payment for the next 4 or 5 years. You know, so hopefully that helps a little bit, you know, in determining. All that matters is that at the end of the day, you go into any purchase confident that you can finance it. Whatever
Okay.
you as the client need in order to feel confident in your purchase, then me as the broker has to try and accommodate that.
And the next one is, as a borrower, what all essential documents that might be required at the time of pre-approval?
Yeah, and that one's pretty straightforward. You know, identification always, right? We're always going to
All
verify
the borrowers, like if it is 2 or 3, whatever, how many borrowers,
every
everyone.
borrower ID first and foremost. I need to know who I'm sitting in front of, right? Now, due to privacy laws, I'm not keeping your ID, but I'm going to check your ID. Okay.
Okay. Just to check. Okay.
Exactly. Then I'm going to need income confirmation. Income confirmation can vary significantly depending on how you earn your money, right? And at the early stage of things, I may not ask for everything that's time sensitive. I may ask for tax-based stuff, so T4s, T1s, NOAs, right? I'm going to look at sort of your annual at this point. What I'm probably going to also ask for is a pay stub because I want to make sure you're currently earning what you're supposed to. Okay. So we'll ask for things like T4s, NOAs, T1s to see what you're supposed to earn over the course of a year, what you have been earning over the course of a year, things like that. We're going to ask for pay stubs to see that you're on track to do that again. Okay. If I saw your pay stub and you're behind $10,000 on your year-to-date earnings, right, versus where you should be, then that's going to pose some questions that we're going to need to answer before we say, okay, great, go ahead and borrow the money, right? We're going to have to check your liabilities. There is this weird misunderstanding out there about pulling credit. And this drives me crazy. I know you've seen it drive me crazy many times, right? Because I don't understand why you would want to go into a major purchase credit blind, right? Not pulling credit is credit blindness, right? And it's gonna have to be done. Now, what people are concerned about is pulling credit a lot and it damaging their credit score, right? That's the concern that most people have when they're looking at this. That's not the concern that we have, right? And the reason why is that when you're shopping for mortgages and loans and things like that, we're pulling a type of credit that's meant to be pulled. When you, as the consumer, are pulling credit, you're doing a maintenance check. It's a one-off here and there that to just check where your score's at. It's not a shopping pull, right? As a consumer, you can't pull a shopping score. You can only pull a maintenance score, right? And so when a mortgage broker pulls your credit, this can be pulled multiple times in a 6-month window, right? Without causing much damage. Does it cost you 6, 7, 8 points off your credit score? Sure.
Like max 6, 7, 8 points or more than that?
It's going to range. It depends how strong and how thick and how diverse your credit is, right? So everybody's going to be a little bit different on how much damage it causes because everyone's credit is different, right? But if 10-point drop is going to kill your ability to get a home, we have much bigger problems ahead of us, right?
Let's
Because
say,
there's not a difference between 710 and 720. Doesn't cause any difference in your borrowing.
let's say most of the A lenders look for like credit scores of 680 plus, and a client has like credit score of 683, and now he pulls credit.
So I'm
then
gonna
it's going to lower.
shock you here, Raul. I'm gonna shock you here. Do you know what a lender actually looks for as the base credit score?
650?
600.
But it's all marketed as 650 above 680.
So many lenders, many insured lending will start at 600, right? At 650, new policies open. At 680, new policies open. At 700, new policies open. But you're not going to discount yourself from getting a mortgage, right? You're just going to have better options the higher your score is, right? Here's the other thing though. If I pulled your score today and it knocked you from 680 to 670, it was going to do that before I submitted the deal anyways, right? And now I just know in advance, right? And we can take some steps over the next month to strengthen your score, right? But before your deal was submitted, that credit was going to be pulled anyways. So I might as well do it early, see if there's any problems, remedy those problems, right? And get in a position so that when we're actually going to the lender, that we know what we're looking at, right? I can fix a lot in 60 days with your credit.
Let's say the borrower is not liking the rate he's getting it from the lender, but he was next again wants to go to a different lender. They again pull their credit score.
So it's only if you're shopping without a broker. If you're shopping with a broker, I have 143 lenders this year that we use, right? I get to use one credit pull to check all 140. right? Good luck as a consumer figuring out who all 143 are, right? You probably know 6 big banks and maybe have seen a couple credit unions on the street. First off, most of those I already work with, right? So, before you walk into TD and then walk into BMO and then walk into Scotia, guess what? I can use your same credit pull for all 3, right?
You're
So,
going with mortgage agent rather than going to single
exactly.
lender, you will credit score will keep
And,
different.
here's the great thing. In the time it's going to take you to go to walk from Scotia to BMO to TD, I could probably have already done all 3 plus 10 others, right? Because instead of doing the application all over again, walking through the process all over again, I get to just use the same application, the same credit bureau, and pick up the phone and say, hey, how's this? Hey, how's this? Hey, how's this? And go lender, 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 lender. Are there ones that I don't work with? Sure. Mortgage brokers do not work with RBC. Mortgage brokers do not work with CIBC. Those you're going to have to do on your own, right? The others we work with, so I'm going to hit them point by point by point, right? If you've indicated to me that you must work with a bank, great. We're going to go and give them a call. If you are open to all the options in the market, guess what? Great. We're going to go find the best ones available, And so the idea of working with a broker is let us broker, Our job is to find product and client and match them together. That's what brokering is, right? And so if you want to shop, use the person whose job it is to shop. That's why we exist, It's not to find best rate, it's to match best product to client, which includes rates, And can I do it when I'm credit blind? No. But let me pull the credit and then go do my job, right?
And like when considering the credit scores, there are different kind of credit scores in the market, like let's say TransUnion, Equifax, or Beacon, or FICO. Like how exactly these differ and which lenders prefer like that kind of thing.
Every lender uses an Equifax for mortgages, okay?
Every lender.
Every lender uses an Equifax for mortgages. Some lenders will also consider a TransUnion, okay? All banks will also pull a TransUnion and an Equifax. And the reason why both are pulled is that certain information falls off of them at different speeds. So, for example, if you have a TransUnion, right, and you've had a bankruptcy in the past, it never comes off your TransUnion. It falls off your Equifax, but it never comes off your TransUnion, right? And so if you've had some bad credit situations in the past, a TransUnion pull is far more accurate sometimes at seeing that, right? Likewise, sometimes the scores are very different between the two. And if I've got a lender that will let me use TransUnion instead of Equifax and TransUnion scores much higher, then I'm going to lean on that as my credit bureau of choice for submission. But typically speaking, we default to Equifax.
And what exactly is FICO then? FICO is between
That's the name of the score. That's the
two.
name. So an Equifax score is called a FICO score.
FICO score.
Yeah.
And,
And there's going to be a ton of terms that are thrown on them, primarily industry terms. From a consumer point, Beacon score is fine.
mhm.
Equifax, TransUnion, those are the 3 words you really need to know.
Yeah. And let's say there are many self-employed people, and also those with T4s, they still do self-employed. Like let's say they
Yeah.
in the part time, like they do Uber or
Yeah.
let's say even in content creation, or like let's say that a realtor has its own T4 job also as he's a side realtor. Like
Yep.
how their income qualifications are calculated during the time of
Well,
pre-approvals.
you can make it pretty complicated if you want to, or you can keep it pretty simple if you want to. So there's, it's really on the choice of the borrower. And the reason why I say that is you're the one that's going to file taxes at the end of the year. And so how you decide to include your income in your tax filing is really going to determine how easy or difficult a deal is to approve. Okay. If I'm solely business for self and I claim, and I'm a sole proprietor, right? And what I claim on my taxes is what I earn, right? I make 100 grand and I show 100 grand and I pay taxes on 100 grand. There's not much difficulty in comparing that to, say, someone who's salaried, right? You're just going to take the T1 general and the NOA, and that's going to show us that. Okay. If you're a realtor, mortgage broker, financial planner, you typically have what's called a T4A, which is a commission document. So commissioned income also pretty easy to determine how much you made, right?
Yeah.
A lot of Uber today versus Uber 4 or 5 years ago are very different stories, right? They now give you slips. They now help you with tax stuff, right? They now made it really easy to report. There was a time when that wasn't true, right? And so really what we're looking at is, okay, what's your annual statement of earnings, right? What did that look like? How much did you claim on your taxes? The key word we're going to keep coming back to is how much did you claim on your taxes, right? Because your verified income, and the term that we throw around is verified income, is the income that you claim to the government. There are ways to reduce your earnings, right? Legal ways to reduce your earnings, right? Working with your accountant to develop a tax strategy is an important part of what's entrepreneurs, small business owners, people like that have to do, right? My accountant and I have a tax strategy. I can tell you, I do not pay the taxes that I would if I did not have a tax strategy, right? But that includes what are the viable write-offs, what are the rules for reductions that you're allowed, things like that. So when you have a tax strategy in play that reduces your verifiable income because maybe your business is paying more or things like that, right? It's very hard to determine what your earnings are for a pre-approval, right? In those situations, we have to use what's called a stated income program. Okay. Normally it's bank statement driven, and normally you're not going to get an official pre-approval from a lender on something like this. Okay. Because the whole thing has to be underwritten. Okay. And you cannot pre-approve unless you you cannot pre-approve that.
And does
Well,
it
you
take a
have an
longer
underwritten.
time than the usual one?
Oh, it's tricky. It's trickier. It's a little bit difficult, but there's advantages to lending that way, right? So, you know, th this is something that if you're a small business owner, if you're an entrepreneur, this is where a mortgage broker is your best friend. Because what we're gonna do is we're gonna sit down with your accountant, with your financial planner, with the other people in your world, in your circle, your other advisors, and we're gonna work within the strategies that exist, right? If I go and I do something with your mortgage and it throws off your business tax strategy, oops, right? That's not the situation you want to be in. You want to make sure that all of your financial people are working towards your common goal. Okay. And there's a lot that we can do for business owners, right? There's a lot of options that exist. There's a lot of lending solutions that exist that are very unique to small business owners and to entrepreneurs and to people with variable incomes. Okay.
And like for the self-employed, like what kind of different programs exist? Like
Yeah.
whose net income or taxable income is significantly lower than like what they make in the business. Like
Yeah.
let's say someone is making 100K as gross income in their business and their taxable is just 20K.
Mhm.
So like
So there's a bunch of different programs that exist from lenders out there. A lot of these are called alternative lending solutions. Okay. You may not find them with your traditional bank lenders, right?
interest
Their
rate, like will they be
interest
getting?
rates are higher. Interest rates are definitely higher on these kind of solutions right across the board. There are some that exist for sole proprietors through the mortgage insurers. Your premium on these is significantly higher, right? You will pay more to use non-standard lending techniques. Okay. And really what it comes down to is you've got a choice. Am I going to save on taxes or save on interest rate? But you don't get to save on both at the same time.
So
right?
what do this alternative lenders see rather than the like traditional or
Yeah.
credit unions? Like
Yes.
on what basis they do qualify, these people? I'm
Yeah.
trying
So
to
for
get.
example, right, I may request 12 months of your business bank statements, right? Plus your business financials. I'm going to look at your deposit history, right? Into those statements. I'm going to calculate that and I'm going to remove some expenses from the list, right? And kind of come up with a dollar figure that's more representative of what you would earn, right? And so say I'm a plumber and I gross $200,000 a year. My overhead expenses are 150 and I pay myself a salary of 50, right? There exists room between that 50 that I pay myself and that 150 that my business earned after expenses, where my income could land for lending purposes, right? Income for lending purposes and income for taxation purposes are not always the same. Okay. Because what I'm looking at is your capacity to repay debt, right? When I'm trying to determine whether you're an eligible borrower, right? The number one question I have to ask is, how able are you to repay this debt? And I look at the documents that prove it, right? Income in, right? Income in is the only way I can tell what your capacity for debt repayment, right? So when we look at the different forms of income in, right? We're gonna ask ourselves, okay, can this borrower reasonably repay this debt, right? And there will be things that create restrictions around this. You might be restricted to 80% loan to value. You may not be able to go to 95% loan to value, right? You may be restricted to 65% loan to value, right? You may not even be allowed to go to 80, right? There may be some additional fees, right? There might be some additional costs as far as interest rate goes. That's okay if the solution allows you to get home and works with you and is actually affordable to you, right? Because the key thing is as most people are aware, you know, you can go get a loan for a property without income, right? There's private lending solutions out there, right? I can go get a very expensive loan. I do not have to prove income, for it typically, and I can go and do that, right? But is that a viable solution, right? If I can't afford to repay the loan, right? And a good broker is going to look at your capacity for repayment and say, yes, this makes sense, or no, I'm causing harm. And if it's a situation that sets you up to cause harm, I generally hold that to the doctor's statement,
It's not the right time.
cause no harm, right? Do no ill, you know, conduct no evil, right? So, just because there are solutions doesn't mean it's the appropriate solution for everybody, right? And, that's where a little wisdom and experience comes into play.
And how borrowers' debt to income ratio affects their pre-approvals?
Yeah, so it's actually your pre-approval and your approval, they're held by the same ratios, to be honest. And so it's always going to be on the prime side. So banks, monolines, which are broker-only channel, credit unions, they typically adhere to the insurer's guidelines. So the mortgage default insurer, CMHC, Sage, and Canada Guarantee, right, have outlined what the appropriate affordability ratios are. And that's 39% gross debt servicing, 44% total debt servicing for people with good credit. Okay. Gross debt servicing is the principal, interest, heat, and taxes on a property. Total debt servicing is those four things plus your credit cards and loans and outside debts. Yeah. And if all of that works, you take those things, you stress test it at 2% above the contract rate, and you compare it to your earnings. If you're 39-44 on those debt servicing ratios, you can afford the property.
But how come few lenders, like even if it is like 60 and 60, then also they do accept it? Like
So not all lenders follow the same guidelines, right? And there is a lot of variation that can exist from lender to lender. Give me 1 second here. Sorry, getting rid of some background noise there. So there is a lot of variation that can exist from lender to lender, right? And each lender is going to have a risk tolerance for a certain profile of client. Okay. And this is where it gets a little nuanced. But an alternative lender may allow for a higher risk profile based on the fact that you've put more loan to value or more equity into at stake. So, if you're going to put 20% of your equity up, right, this lender may allow a higher debt servicing ratio, right? They may allow more at 75% loan to value, right? And so as your position changes, their risk tolerance may increase. Even with some banks, right? That 3944 might go out the window if you only have 65% loan to value.
Got it. So it all depends on the LTV.
Exactly. Loan to value is magic because you're not likely to walk away from a home that you have 20% stake in. You're definitely not going to walk away from a home that you've got 35% stake in or 50% stake in, right? And so the less you owe, or the more likely you are not to walk away from your home, the more likely you are to pay the bills, the more likely you are to get some leniency on the lending. Okay. You can't walk to the table with 5% down and expect leniency. Doesn't happen, right? You also, you can't walk to the table making $30,000 and expect to get $1 million property. In no situation is that ever going to happen on the loan to value, right? Because things like property taxes, other expenses to maintain the property are going to be so high that just the income alone wouldn't be enough to service the expense of managing the property, right? So there is a limit to how far, the leniency can go.
And when coming to the employment history,
Yep.
like for someone who needs to get pre-approved, like few people tell like only 3 months employment history is fine, but few lenders want like one year or 2 years of employment history. What should be ideal for someone like in case of pre-approval? Like
Yeah, in a perfect world, we have what's called the rule of two. All right. So 2 years of employment history, right? 2 years of credit history, 2 credit lines, $2,000 limits on your credit, right? If you have those 4 things, you're the easiest candidate on the planet to lend to, right? Anyone with a pulse can get a deal so long as they can afford it, right? That's not always the case, though. In a perfect world, in reality, not all of us have 2-year employment histories, right? Not all of us have all those things in play. So when we're dealing with employment in particular, some lenders will want to see 2 years of industry experience, right? The idea with income is how replaceable is it, right? The question we're always going to ask is how replaceable is your income? If it's easily replaceable, then the qualifications to prove it are much lower. If it's very difficult to replace, the qualifications to prove it are going to be higher. And what I mean by that is, if you are an experienced engineer, your chances of getting another job comparable in value are pretty straightforward. If in good market conditions, you could change jobs readily, fine, right? No problem. You can still be on probation and get a mortgage, right? If you are, running 2 side gigs, working part-time, right? Making some content creator income on top of it, right? And your income's scattered, it's all over the place, it's unreliable. It's very hard to replace that kind of income. I can't just walk in and get a job and replace that income in the same way. So now I'm going to have to show a 2-year history of income, right? That history will then help me with my qualification. But if I've got a really stable white collar job with a great salary and benefits, then a pay stub, show that you've been paid once, that could be enough.
Let's say for those like who has like let a person has a household income or like individual income is like 150K, but he's has just like three months of employment, like
Mhm.
he just started 3 months back.
Yep.
But those with a 100K package and they have 2 years of employment history.
Yep.
So in this case, like how does it affect? Like will
So
they both get the same equal importance or?
yeah, so what we can always show is growth in earnings, right? We're always good to see that you're making more money today than you were yesterday, right? So if I've recently received a promotion or a raise or a new position that pays more within my field, right? Then it's going to give me additional allowances, right? And that's okay. I just need to prove that the money's being made now. Okay. I just need to show that this is how we're generating the income today. So a couple pay stubs, maybe, show that it's not a one-off. My letter of employment is going to be very important on something like this, right? It's going to show us that, my employer's on track, new contracts to reflect the changes, right? These are all going to be things that are, looked into. It's hard to say, in a hypothetical sense because every job's a little bit different, right? A lot of if you're not certain what's going to be necessary, let's always start with a letter of employment and pay stub, right? The letter of employment tells us how we get paid. The pay stub is going to tell us what you get paid and that you are being paid, right? And so those are always two really great documents to ask for if you're uncertain with how your employment's going to be shown.
But and also when coming to the pre-approval documents, is
Yeah.
NOA literally like it is very important or is it okay? Like because for someone who is looking for housing, like they have 10 months of employment history, and they will not have like if like financial if they don't have the employment NOA,
Yeah.
they didn't file the taxes yet. In that case, like what exactly it happens? Like NOA is very important or?
It can be. And so what I always warn people when you've got new income,
Mhm.
nothing's guaranteed until an underwriter's looked at it, right? There are a few workarounds. If you're a newcomer to Canada, right, and you qualify under a newcomer program, right, there's different criteria that exist for them than exists for people who are naturalized or long-term citizens, right? There's different expectations, right? So if you're a newcomer, for example, I don't want you to be business for self trying to get a mortgage in 3 months, 6 months in, right? Not going to work, right? We need to see history of employment, right? But if you're a newcomer and you're 6 months in and you're an engineer and you can show me a contract and a salary, awesome. I've got a mortgage for you, right? There's a lot of variance that can happen depending on the programs that are out there. If I'm new to business, if I've started up a business within the past 6 months, right, doing something that I've kind of done for someone else for years, right? So let's use an electrician. I worked for a company in electrical for years. Now I'm a do-it-myself electrician, sole proprietor. With after 6 months, I can use that income that I'm making and that's okay, right? Because I've got a history in the field that makes sense for the transition. If I'm a realtor with a year, I'm not getting a mortgage. Not traditionally because there's fluctuations in sales cycles, right? As we've all kind of seen over the past couple of years, the markets are unpredictable. And so because there's fluctuation in it, there's going to be a 2-year history of earnings, right? These are the standard rules. There are exceptions that exist to a lot of these standard rules, though, right? And so, it's better to have somebody review your situation in detail before you make the decision to buy.
And for these people with a low employment history, like will their interest rates might increase, like even with the same traditional banks? Like if someone goes with a good employment history, they will be getting a lower interest and with the low.
Yeah, generally, the more secure you are so we call them the 5 C's of credit, right?
Mhm.
The better you are on these, right? typically the better rates and terms you qualify for, right? The weaker one of them is, and cash flow is a part of this, right? Is, the worst terms and rates you'll get, right? That's There's no one size fits all answer to this kind of question. And I think a lot of people do wish there was a generic, yes, we can go ahead and do it. But this is really where you need someone with a bit of experience to sit down and review your scenario and go through 2 or 3 different options that might exist on how to accomplish your home ownership, right? There could be 2 or 3 different ways to get to it if you've got short employment. Private lending exists, right? That requires no employment history, right? There's alternative lending options out there that require reduced employment history, right? There are some careers out there that you don't need any employment history for, really, let's be honest, right? And so it really is case by case. And this is where, before you act, right, you should always seek guidance and advice, right? From somebody who knows, right? This is the other piece, right? Make sure that you're dealing with a qualified agent or broker who is comfortable with your type of scenario, right? We forget often to interview the people we're working with before we work with them. My cousin might be the best realtor on the planet, right? But he may specialize in condos, and I'm trying to buy a duplex. He may not be the right fit for my scenario, right? Likewise, my specialty as a mortgage broker is actually in unusual incomes, right? I'm not lovey-dovey when it comes to first-time home buyers, for example, right? Because I don't do a lot of them, right? I deal with a lot of stated income business owner type stuff, right? And can walk people through those challenging situations better, where I may not remember all the rules for the basic insured stuff all the time, right? Because it's not on my plate every day. Right. And so it just depends. You should qualify what the specialties of the people you're working with are. Now, granted, can I do first time home buyers? Absolutely. I started with that, right? When I related to it, right? More, but my specialization is over in this field, right? Ask them, what do you specialize in? What are your niche markets, right? What do you understand really well? Check the licensing levels, right? Don't try and do a private deal with someone who's not qualified to do private deals. Right. That's what I would warn people about is, seek good advice early. And if the advice you're hearing doesn't sound right, run away. Get out of there fast. If you hear something weird, like, oh, we'll just make the documents for that, go fast, right? There's no easy solution. There's the right solution. And income is one of those areas you don't want to muck up, because if I go doing research, and the underwriters research, they're going to check employer websites. They're going to look for directories. They're going to check your social media. They're going to look for inconsistencies, right? If they find something.
Operators check for social media?
Oh, yeah, absolutely. The first thing that I do as an underwriter.
Something new, I never knew that.
The absolute first thing I do when I underwrite a file for a client is I check their LinkedIn.
Oh,
I will always check your LinkedIn when you start a deal with me. If I don't see the profile, or if the profile doesn't match, that's going to set up a flag, right? If I'm going to go and check your Instagram. If it shows that you're partying and traveling all the time and not, looks like you're doesn't match the lifestyle that you've
Is
claimed.
it like something you personally opted, or
No, this is what all underwriters do.
all underwriters do?
All underwriters have been trained to
I
search
never knew
social
that.
media. Yeah. Because that's where I'm going to find you lying.
So rather than just depending on the papers, they also go with the personal.
Absolutely. We do, Google search. Everyone gets Google searched, right? What's popped up in the news around your name, right? This is important stuff. Like, if you've been convicted of fraud in the past, guess what? Who's not going to do business with you moving forward?
Okay.
Anyone,
Mm.
If you've been convicted of a crime in the past, most lenders won't lend to you out of reputational harm.
Okay. Even if everything is good, like they don't lend.
If you've been convicted of a crime and had to serve time or something, then they may not lend to you, even if you look like a good client on paper. So, understand that one of the C's of credit is character.
Mhm.
One of the 5 C's of credit is character.
Yeah.
And a lender will do character research to make sure that you're the ideal client for them, right? As much as you want their money, they want to make sure that they want your business, right?
Mhm.
And it's very interesting. It's an old way of lending.
Do they also check for the reason, like why it happened?
Oh yeah, all research will get done. All research will get done. You know,
Mm.
they're smart. Underwriters are smart people. They're analytical people, right?
Mm.
They're people that are based on finding pattern and design, right?
Yeah.
And they will they find out things, right? And so our job is to make sure that when we're presenting your case to a lender, right,
Mhm.
that we're presenting the most beneficial case possible to meet their needs. Have I talked about your character? Have I talked about your credit? Have I talked about your capacity to make repayment on the loan, right? Have I talked about the collateral, the home that we're buying, right? Have we done these due diligences to make sure that I haven't put you in a position that you're going to fail, right? My job as a mortgage broker is to make sure you get your mortgage paid off, to make sure you keep a home, right?
Mhm.
It's not to get you into the home. It's to make sure the home I get you when it's sustainable,
Keep it forever.
right? You know, if there's lots of ways to get people into homes, right? My
Mhm.
job is to make sure you can keep it. you know that you don't have to work 150 hours a week to make the bills, right? That
Mhm.
it's realistic, right? There are steps that are taken. The pre-approval process helps us weed out the bad decision making early, right? I would rather have this conversation with you before there's a live deal, right?
And there are many lenders and mortgage agents in the market who give the final rate even before the pre-approval. Like, how do they even give? Like, let's say I was talking to a client recently, and I'm telling like you might be getting rates till this one, but until and unless I apply any discounts or any negotiations, I can't tell the final rate what I'm giving to you. But
Yeah.
I miss that client just because some other lender or mortgage agent, he just gave him the final rate. Like, this is the rate
So,
I can give.
and then this is because I trained you, that you don't believe in forevers or firms, or putting the cart before the horse, to say. I cannot guarantee you anything until I have a commitment back from the lender. And even then, the lender has the right to change things once they've issued a commitment. So, up until the day your deal funds, I can make absolutely no guarantees. What I can do is I can speak confidently about things. I
Like,
am confident that you can get this, but I cannot promise you anything. And to do that, if I did, I'd be dishonest.
mhm.
I would be unethical. I'd be lying. You know, um, I cannot tell you today, Raul, that you will get $500,000 in mortgage at 4.49%. I cannot promise you that.
Even after the pre-approval?
Even after the pre-approval, even after it's been committed and gone live, I cannot promise you that, because something might change along the way, that now all of a sudden this deal doesn't work the way we thought it would. The property might come in wrong. There might be a market rents attached to this, and the rental market shifts down, and now the affordability is there. I might call your employer, and where you thought you were 40 hours salary, you're actually 37.5 hours hourly, and your income is actually different than we
How
thought.
does that affect?
Well, because most people aren't actually fully aware of how they get paid. And sometimes the way you get paid,
7.5.
yeah, sometimes the way you think you get paid is not exactly the way you've been paid. And so as we start doing our verifications, right, things could change. So anything I say to you today is subject to lender approval and review of income, property, and credit, right? Those things can change anything, right? And so it's wrong for me to leave you with the impression that you're guaranteed anything.
Wow.
But I can be confident that you qualify for this. I can be confident that you will achieve, that you can have this rate, right? Based on everything I've reviewed and seen, this would make sense to me, right? Here's the difference. If something changes, you're prepared. I've prepared you for a plan B, a contingency, things like that, right? Only idiots walk through life thinking that anything is guaranteed, because nothing in life is guaranteed. Find me one thing in life that's guaranteed outside of taxes and death. There isn't, right? And so why would I tell you something was guaranteed when we know for a fact it's not, right? That's not me being a good salesperson, right? That's not me being a good advisor. That's not me being a good broker. That's me being, someone that enables an idiotic action, right? Stuff happens, life happens, events happen, things change, right? You could get a pre-approval, lose your job. Guess what's no longer guaranteed, right? Your mortgage. If I told you, well, I promise you I can get you this, right? And then something in your life changes. Well, oops, right? And so I think it's more like maturity and wisdom and integrity tells us not to make promises we know might not be kept. Can I give you 99% confidence that this is going to be the case? Sure. Is there a 1% chance that all hell breaks loose next week? Yeah, there is. You never know, right? Things happen. We learned, we learned during the pandemic to stop trying to predict the future. We didn't know the society as a whole was going to shut down. We didn't know real estate markets were going to explode. We didn't know they were going to crash, right? We didn't know any of the things that happened were going to happen before they did. Anyone says they did is lying, right? Nobody was able to predict what was going on, right? So we learned not to guarantee anything, right? But I can speak confidently. I've reviewed your data, I've reviewed your documents, I've spoken to a lender, and I confidently believe that you can have this, subject to final verification, right?
Like
That's
many mortgage agents, I see like they are doing business on this. Like they tell the final rate first, and then they attract the client.
yeah.
Not sure what happens next.
Well, and what you'll see is that there is a group of mortgage agents that exist that will make a promise that they don't intend to keep, and then will bait and switch their clients before closing, right? I guarantee you can get this bank rate. They wait, last minute. Oh, something fell apart and we have to go private now, and I'm going to charge you $30,000 worth of fees, right? That's not good business, and you don't need to do business with people like that, right? Not everyone's going to come through this business with good character, like in all sales professions, right? Not everyone's going to have great character, and character matters, right? Work with people who are trustworthy and honest. I'm not going to tell my clients everything they want to hear, and I might tick them off a little bit, but I'm always honest with them and transparent with them, right? Even if it doesn't look good on me, right? Because that's just the type of person I am. My mother told me not to lie and hit me a few times, and I learned not to lie. I go through life that way. Not everybody does, right? So it's very important to look at the character of the person you do business with. A good salesperson doesn't tell you what you want to hear. They tell you what's true, right?
That's where those people lose business sometimes as well.
Yeah, absolutely. I've lost more business than I can count.
Mhm.
Here's the great thing. I've never been sued, and I sleep well at night.
Yeah.
I don't sleep on a huge bed of money, but I sleep well, I'm okay losing business if that business was bad. You know, I'm okay losing business if you wanted to go with the scam artist. I feel bad for you if you did and things go bad. Please don't come back to me, right? You know, I think it's okay to lose business that was never meant to be yours. You know, people who want to work with us, they'll work with us. They'll see the quality of your character and they'll want to be in business with you, right? And it may take time and it's a slower path, right? But it's a path that will keep you in the industry for 40 years if you want,
Mhm.
It's one of those things. The quality of our character matters. Yeah.
And as you told, let's say the rate currently, it says 4.69, but the lenders, if you want a rate hold, they'll keep it at 4.89.
Yeah.
But what if in the pre-approval time, even if the rates increase more than that, let's say it is going up to 5.1,
Yeah.
what lenders
You're
still
okay.
agree for 4.89?
Yep, you're okay. So a pre-approval for a period of 90, 120, 150, 180, depends on the lender, right? For a period
Okay.
of time, they have earmarked money at this cost.
Mhm.
Okay. So when you get a rate hold, right? The one for say I've got $500,000 earmarked for 4.84, right? They're going to take that $500,000 and they're going to put it aside at that interest rate for you. If you take 91 days on the 90-day rate hold, guess what? That money's gone, right? If you need $505,000, guess what? There wasn't enough money put aside, right? So sorry, we can't accommodate that, right? You have to be very specific here, right? If I want this amount, this is the cost for it, and it's being held that amount at that cost for that period of time.
Mhm.
Almost any material change can invalidate that. Okay.
Let's say you told different lenders have different time, 90, 120, 150. Will
Mhm.
there be any flexibility option with the lenders?
No, there is no flexibility typically because what it is they are allowed to hold a amount of funds for a
Mhm.
certain period of time based on the cost that they borrowed those funds themselves, right? So that's where things like bond yields and whatnot come into play, right? This is the price that they borrowed the money at. They've held that money for a period of time, and it's okay, but that cost could change day by day, right? And so they won't have flexibility because they've got to turn that money at a certain speed.
And let's say the borrower needs 500K and he got rate hold of 500K, but after let's say after 80 days, he wants 550 and he got that 50K as a gift letter, then all the pre-approval process needs to be changed, or will there be some?
So long as your mortgage amount never changes, your property amount can always change, right? Your property amount can change, the loan to value ratio can change, these things can change, but the dollar amount of your mortgage should not change, right? When we're dealing with a pre-approval. There are a few lenders out there, however, that don't consider the amount and more consider the day. And they will say, okay, every rate hold that was received on, July 1st, is going to be at July 1st pricing for the next 120 days. And it doesn't matter how many dollars that amount was. They exist, they're out there. There's only a couple of them though. And so that's where maybe if we're uncertain about where interest rates are going, right? Picking a lender that might be a little bit more expensive, but holds the whole day worth of interest rates might be a more valuable option than someone who's a little bit cheaper, but only has like a dollar cap, right? So there are different scenarios out there with different rules, and it's the mortgage agent's responsibility to help you position with the right lender for that purpose.
And at this time, after the stage of pre-approval, the borrower chose the lender, and initially he wanted to go with the fixed. And seeing the market, they wanted to turn it to, like, after accepting with the lender, they want to turn it to variable,
Yeah.
or vice versa. So
Yeah.
what happens, like how lender reacts during
So
the
typically speaking, there's two things that could impact here, right? So fixed rates are more volatile than variable rates, funny enough, because variable rates typically only change when the Bank of Canada makes rate adjustments, right? Fixed rates move based on bond yields, right? So fixed rates are more fluctuating and more variable, and have more chance for change than a variable rate typically does, right? Variable rates, what you're doing is you're locking in your discount against prime, or your premium against prime, right? And that may change over time. Okay. Fixed rates, you're locking in a rate today. So let's say 4.79 today, right? Variables, I'm locking in a discount against prime minus 1 would be the comparable, right? Bank of Canada will change prime throughout that time period, but I've locked in my discount. Now, discounts typically are slower to change than your fixed rates. So often it's okay within that time frame. There may not have been a change to discount, but if you didn't lock in a discount rate, then you won't receive it when the time comes, unless you use the lender that locks in the whole rate sheet for the day. Okay. And so you kind of need to know early, am I going fixed or variable, right? And have that conversation early in the shopping process, right? So like I use variable rates for myself typically. You know, I like variable rates a lot. I like variable rates a whole lot right now because there's two major reasons. One, I'm very conservative about my spending, right? I don't like to overspend on real estate, right? Right now variable rates are higher, right? They're more expensive. It's a reduced buying capacity because of that, right? But I know the direction they're going is down. You know, RBC anticipates 2 more rate cuts this year. They still think there's a strong chance of September and another one at the end of the year, right? That's 50 basis point decrease, right? Over the course of this year, that's going to be worth a full 1% decrease in interest rates, right? So we would have moved down from a 7.2 prime to a 6.2 prime. I have prime minus 1 on my real estate. Well, I got more than prime minus 1, but about prime minus 1 on my real estate. So now I've gone from a 6.2 interest rate to a 5.2 interest rate, right? We know that this is not the bottom of the market yet. We know it's got further to go, right? The anticipation that a lot of the lenders have is for the prime rates to stop around 3% for overnight, so 5% for prime, right? Which means that the discounted rate should be about 4% when it stops, right? So if that holds true, then when rates are at 4% on the variables and fixed have readjusted, I can take my fixed and switch it to a variable, or take my variable and switch it to a fixed, and lock it in once rates have stabilized at the bottom, right? With a fixed, if you want to change it, you're going to have to break it. And to break it, you're going to pay a penalty, right? So I like, if I can afford a variable today, to ride the market down to a position where I'm happy, and then I'm going to fix the rate in while it's at its lowest, right? Instead of taking today whatever is being offered and having to then pay a penalty to break it and renegotiate later. Right. That being said, I have to decide early whether I need the stability of the fixed rates or if I'm comfortable with the fluctuation of the variable rates, right? And I'm not going to say one's better than the other because one isn't better than the other, right? Each one serves a different purpose for people, right? If I have to break a variable, it's cheaper. It's 3 months of simple interest. There's no differential penalties or things like that, right? So I like that flexibility as well, right? Have that conversation day one with your broker. Right? What's your comfort level? Let them show you both options, right? A good broker should show you options, 3, 4, 5 different options, right? This is what a 5-year fixed is going to look like. This is what a comparable 3-year fixed is going to look like. This is what your variable is going to look like. This is how they play out over their terms, right? This is the expectation at different intervals, right? Which one makes more sense for you, right? The bad broker says, take a 5-year fixed, it's the cheapest. Or take a 3-year fixed, it's a short term. And so in 3 years, things are going to be better. We don't know that. We don't know 3 years from now is better than today, right? Have that conversation in 2019. Tell me 3 years later was better, right? We don't know what's around the corner, right, in 3 years. So I cannot guarantee you that 3 years is going to be better than today. Likewise, I cannot guarantee you that rates are going to continuously go down, so maybe the variable's not better, right? What I have to do is I have to put the options in front of you and say, okay, Raul, seeing the numbers, seeing the stats, what do you think is the best suited for you today? Right? Because the only thing I can guarantee you is today. Right? This is how you really separate a good broker from a bad broker. A bad broker promises you things that are coming. A good broker talks about things that are in front of you. Right? I'm not here to make promises. So I know we went on a bit of a tangent there, but hopefully there's some good content.
I hope so.
Yeah, right.
I feel I'm covering like there are many questions. Like I have like a couple of more.
Absolutely.
And like during the pre-approval time, like let's say the client is okay with 10% down, then after like either if they want to increase or decrease their loan to value, then what happens during that case?
Yeah. So increasing your loan to value, so going from 10 to 5, for example, right?
Yes, yeah, interesting.
That's not going to happen. That's gonna be a material change. We already,
Everything needs to be then rechange again.
yeah.
Um,
But needing less money is always acceptable. If I put $500,000 away, but you only need 400 of it, great, awesome, no problem, right? Coming down is always easier than going up, right? Going up means new money, new expenses, new costs, renegotiate, right? Coming down means whatever.
So if someone want to go down, like then they have to
That
inform earlier.
should be perfectly okay. Again, some lenders might have rules where that's not acceptable, but for the most part speaking, the way the money's held, less is okay. More is less often okay.
And
Some lenders, again, though, okay with moving up, right? Within small variance.
and even after the pre-approval, few borrowers will not get their loans approved. Like there might be one chance of like the employment issues or social media issues, but other than that, like what kind of chances about that?
Property. The property is the number one killer of deals, right? There are so many reasons why a property may not be accepted, right? Disrepair. Disrepair is top on the list, right? If a lender wants a property in good condition and it's not in good condition, they do not have to lend on that property, right? Location. Some lenders have location restrictions, right? So, if the lender doesn't let you borrow in downtown Toronto, you're not.
Are there any lenders who doesn't?
There are some lenders that do not allow lending in downtown Toronto. They are more outskirts.
Any major banks?
No, No, all the major banks are okay with downtown Toronto, but you know, but there are these one-offs here and there, right? There are certain locations within cities, though, and certain buildings where the insurer says, no, this is on the do not lend list.
So for at least this one, like borrowers have to go with the mortgage agent so that they can see where the best, like,
Correct. Well, and even as a mortgage agent, sometimes we aren't aware of the do not lend lists until the lender informs us. And the lender may not even be aware of the do not lend list until they've submitted the deal to a
underwriter informs.
insurer, right? So the underwriter may have to submit the file to the mortgage insurer, CMHC, Sagen, right?
Okay.
And they may go, no, actually, we don't lend on that building. And your deal's dead.
It's all chain reaction, like
Exactly. And so because there are so many things, you know, there's a downtown Toronto where I'm at, right? There's a notorious building called 36 Lisgar. And 36 Lisgar used to be on a lot of do not lend lists, and you could buy in there relatively inexpensively if you had 20% down. And it was on a do not lend list for mortgage insurers because there were outstanding litigation against the building. Right. And because there was an issue with between the condo core and the developer at the time, right? And there was an expected litigation doing and that outstanding, it had appeared on one of the mortgage insurers do not lend lists, but it wasn't on all of them.
But
Right.
does this happen in case of 80% LTVs as well?
Now, when you're 80% loan to value, the lender doesn't have to insure the property and they can take some risk on themselves, right? And so in those situations, we didn't have any problems lending on that property because the lenders were like, cool, we don't see a problem here, right? Where the insurer felt there could have been a problem, right? And
Because
so
okay.
if you only had 5% down and you only qualified under CMHC's guidelines, for example, you may not have been able to buy in that building, right?
Yeah.
There are locations in Hamilton that are too industrial for some mortgages, right? Some mortgage insurers will not go into some highly industrial areas, right? So you can see that in places like Hamilton, great example, right? And Windsor used to have lending restrictions on it, right? Especially after the crash. It took over 10 years for Windsor to be 80% loan to value or greater again.
Oh,
Yeah. There were huge restrictions on the city, right? And so you cannot be 100% certain that your property is okay. Zoning could kill your property. You could have your pre-approval with a lender, and you could be purchasing a property that's agriculturally zoned but looks residential, right? Some lenders might be okay with that. Other lenders might not, right? It could be in a perfectly normal neighborhood, but the zoning hadn't been updated yet. Dead deal.
And apart from property, what other reasons could be?
That's going to be your major, but you know, job loss. Absolutely job loss. You know, I go to call your employer and I will call your employer as an underwriter, right? And they say, well, you know, Raul hasn't been working here for the past 3 weeks. You know, he's kind of a bum and never showed up. Oops, your income's gone, right? Dead deal, right? You down payment typically shouldn't be a problem. That one we should have figured out long in advance, right? But you know, what if
Figured by us, right? Like as
yeah,
per
as a broker, we should have figured that out early and had some questions around that, right? You know, but some lenders don't let you borrow down payment, right? Some lenders down payment must be purely from your own resources, right? Some lenders let you borrow down payment from secured lines of credit or other resources.
they do?
Yep, there are programs out there. You know, if you were depending on being able to borrow from a secured line of credit to make up part of your down payment, right? But that lender doesn't allow it and you disclose it at the end, right? Dead deal. Right. And so the more questions we can answer early, right, the better it is. You know, what we can do at some point is we can talk about some of the real nuances in lending styles, what some allowances are, you know, like the flex down mortgage that I hinted at, where you can actually borrow some of your down payment from secured credit sources, right? So long as you can service the debt, they'll let you have it, right? It's one of the few ways you can actually do a zero down mortgage, right? Again, you have to have really strong income to do something like that, but we can go into some of that stuff a bit later. But there's nuanced products out there, and there that may exist with one insurer and not the other, or one lender and not the other. And if you are expecting your deal to qualify using one of those programs, and we find out partway through that lender doesn't offer that program, then your pre-approval is not going to work, right? So, again, that's why I don't like to talk in uncertainties, right? Because as life happens, I've done this long enough to know that nothing is for sure, but I can be very confident about stuff.
And the final one, like any advice to the home buyers, first-time home buyers, or anyone who is looking for the pre-approval process, what they all need to get ready with, and they do not confuse, and whom should avoid and whom they should go.
Yeah, so here's what I would always do, right? Get your basic documents in order first, right? I should know how I make my money. I should know how much money I make. That should be easy, right? So I should have my tax information done first, right? I should know where my down payment's going to come from. I should at least have an idea of that, right? Is it my savings? Is it investments? Is mom and dad helping me out, right? Is it from the sale of a property? Where's my down payment coming from, right? I should have a rough idea where my credit is. I probably know how much debt I've got. I probably know roughly where my credit score is, but get ready to sit down and do a credit review, right? I want to make sure there's nothing wrong in my credit, right? Things that
One question
yeah,
regarding credit
yeah,
score, I just got
yeah.
it. Like, let's say I have an Equifax account, I can check it on my own. Like when the mortgage broker checks and when we check, like, do you see any difference, or it might be the same
They're not
score?
the same. They're not the same credit score.
Even
You
the
have
score differs?
score is different. Information provided is different. Yep. So what you're not going to see really with a consumer account is the depth and history of the credit. Probably going to see the score and the trade lines, but you're not going to see any public records. Maybe you may not see the repayment history over a period of time, right? There's information that's on the credit providers score that's different than the one that you have, and typically the variance can be between 30 and 40 points sometimes in credit score between what my score will show and what your score will show. And so it's great that you might have checked yours periodically, but I'm going to review it and I'm going to go through it in detail. I'm going to make sure the information that your personal information is correct, that your employment information is correct, that your SIN number is there, right? That you're showing your public records correctly, that all the trades that are active, that the ones that are closed, right? We have to go through and meticulously pick through and make sure the thing is correct. And some old geezers like me might have 4, 5, 6 pages of credit report to go through. Some young fellows might only have 2 or 3 pages to go through, right? But it's important to go through and make sure that that is accurate early. If you don't know, you cannot fix, right? If we know, we can fix, right? I can dispute Equifax issues given time, right? But if you made an offer to purchase, and now I pulled your credit and we've got 5 days to waive financing, I can't fix in 5 days, right? So going in early, right? Be conservative when doing your pre-approvals and stuff, right? Just because you can qualify to purchase up to $700,000 or $800,000 of house price does not mean you are obligated to purchase that much house, right? Just because these are your max numbers doesn't mean they're your only numbers, right? Super important. And be aware of property taxes. Property taxes are the silent killer in deals, right? We're lucky we live in Toronto. Our property taxes are very low, very, very low, extremely low. We pay less than 0.7% on property taxes against the
Is that because of many properties?
It's the number of properties, you know, that we pay double land transfer taxes is a big piece of it, right? We pay more upfront when we purchase, so that we pay a little bit less when on the hold, right? You know, be aware of land transfer taxes, right? You know, that's a big surprise sometimes. But, you know, when you go out to say Windsor has property taxes of 1.9% the MPAC. You know, they pay 1.2% more, like higher property tax than we do.
Oh, okay.
That can have a huge impact on your affordability, right? So just because you were qualified to buy in Toronto doesn't mean your dollar qualification is going to be the same in Kitchener or London or Windsor, right? Understand the price changes that can happen from city to city, right? You know, if you qualified to purchase in Kitchener and you come to Toronto, be ready for double land transfers on your closing costs, right? Yes, you get the rebate if you're a first-time home buyer against both the municipal and the provincial, but that's not going to cover them.
You still have to pay some amount. Like
You're
it's not
still going to pay
just
something.
8,000 what you get. Like it could be 12, 15,000 as well.
Guarantee there aren't properties cheap enough here that you will get a full
It
cover.
definitely
Yeah.
it definitely goes more than 8,000 for sure.
Absolutely, absolutely. And so, you know, these are the things to kind of be aware and prep for is, you know, and here's the thing, you know, a lot of clients may try to hold back some information because they think I'm the CRA or I'm connected to them, or you know, I am the lender, or I'm these things, right? Like it's better to be upfront and honest about your situation and let us figure it out together, right? So you owe income taxes. Cool. Let's figure it out, right? Oh no, your business lost money last year over the year before. Great, let's figure it out, right? It's better to be honest and upfront with us so we can work with the information in front of us, right? If you're buying a rental, buy a rental. If you're buying an owner occupied, buy an owner occupied. If you're going to buy an owner occupied with a rental suite, tell me, right? Let's figure it out. Guess what? If you're buying an owner occupied that has potential for a rental suite, but you're not planning on renting it day one, I can still utilize that rental income, right? We can still make it work because the potential for that's there and the goal is to use it. Awesome. You know, I can come into a house that's built to have a rental suite, doesn't have one yet. I can get worked into your mortgage amount, the construction cost of putting that unit in, and then go and use the projected rental income to help you qualify, right? And then the lender will pay you to add the suite. You know, there's all kinds of incredible options that are out there. But if I don't know what your plan is or what your situation looks like, right, I can't go to my list of options and help you pick the right ones, right? So being honest during your pre-approval period is super important, right? It gives us the ability to help you pick the most suitable products. And there's a lot of them out there. You know, you've been doing this for how long now, Raul? About 6, 8 months?
Yeah.
Give or take. You've been working with me. We still learn something new every day. You know, I've been doing this for almost 20 years. Guess what? I still learn something new every day. You know, you can always be surprised. And that's a cool thing, right? So honesty helps us do our job better, right? Being upfront and straightforward with us helps us better your situation, right? And put you in the right thing, right? That's pretty much my advice in a nutshell when we're dealing pre-approvals. I mean, that was a bit long, but I'm sure we can cut this down into a whole bunch of content.
Yeah, I want to go.
We want to go further, right?
I want to keep it like a big podcast.
Yep.
Like I want like everyone to know what exactly they need to know. One last question, like
Yeah.
what I was asking, like whom should borrowers avoid and whom they should go with?
Yeah. And that one's really interesting. So you have to use your gut instincts a little bit, right? You have to use your intuition a little bit. The most important thing that I look for when I'm looking to do business with someone is, do I trust them? Do I trust my realtor? Do I trust my mortgage agent? Do I trust my accountant? Do I trust my financial planner? And, you know, and I'm not just going to give them the trust, they're going to earn the trust, right? So what have they said in the past? What is the content they put out? What is the education they put out? I research people before I work with them. I research them for a long time, typically before I work with them, right? I want to make sure that their credentials are good. I want to see what they've been saying and that there's consistency in their messaging, right? Social media has made it very easy for us to hunt for good, qualified business partners, right? And I look at it as a client, like I'm picking a team of business partners to help me succeed at life, right? You know, I'm gonna research the crap out of the people I work with, right? I want to make sure you know what you're talking about, right? I want to make sure you're connected to good people, right? So, you know, where you might be a little bit newer to the field role, we work very closely together, and I've been around for a very long time, right? And you could know, you pick up the phone and call me whenever you've got a question, right? So, you know, when you're dealing with a younger agent, who's mentoring them? You know, ask them, you know, it's not rude. You know, if you're working with Raul, call him. Hey, Raul, who's teaching you what you're doing? Great. I'm sure he'll tell you and you'll go do some research, right? You know, you know, when I'm dealing with my accountant, I want to see what companies my accountants worked for before, what positions have they held, what do they specialize in, right? My financial planner, I've got one of the best ones in the country. How do I know? Well, because other people tell him he's that, right? He's been in a lot of publications. He's very successful at what he does. So I'm really comfortable doing business with him, right? And taking his advice, right? If I'm sitting in a room and the person across the table from me is telling me to do something illegal, guess who I'm no longer trusting? The person across the table, right? My judgment says this sounds fishy. This doesn't seem right. This seems wrong. I'm no longer going to take that person's advice and our relationship ends, right? You know, I don't have to do business with someone if I don't like them, right? If I don't like what I'm hearing, I can go away, right? What I'm not going to do is I'm not going to leave somebody for being honest with me. Hey, Matt, guess what? You can't afford a $2 million home. Oh, that pisses me off. I'm going to go find someone who says I can.
Yeah.
Mortgage brokers don't control math. You know that, right? We don't create, none of us are Isaac Newton. None of us are going to create a new formula of math, right? We all use the same calculators, right? It's not like my math is different from someone else's math, right? If you make $100,000 a year, you're going to qualify for $400,000 a mortgage. And that's just the end all be all, right? You know, if I want $800,000 a mortgage, guess what? I'm going to make $200,000 of household income, right? You know, if I want $1 million, I'll make 250, right? It's like the math is the math, right? And so if somebody tells you something that sounds fundamentally wrong to that, probably stop taking their advice, you know?
Even what I suggest to clients is like, whenever you go with someone, don't just depend on one word answers. Ask questions, get back
Yes,
with us, and let them ask you questions.
exactly.
That's the
Engage.
person you need to work with rather than just the one who tells like, okay, we can do that. Just
Absolutely.
one word answers. Don't ever depend on one word answers.
Yeah, get them to educate you too, right? So, yes, you can do that. Okay, how can I do that? Right? Get them to explain, like when you sit down with me, you should walk away knowing more about mortgages and financing than when you came into the room, right? That should be the standard for every conversation we have, that you learn a little bit more, right, from it. If someone's not educating you as to how things are working, that's not a good sign. Work with people that will empower you, right? Share the knowledge with you, right? Make you understand better what you're trying to do, right? There's some great opportunity. You know, the best educators give their information away for free.
Yeah.
You know, you'll go buy the book later because you appreciated the information they provided. You know, bad bad-willed people put up roadblocks between you and knowledge. right? Because if you know, you can see the problems, right? Honest, good people will empower you with more knowledge. They are the ones you want to work with, right? You want to be excited walking away from a conversation with us, right? You don't want to feel uneasy, right? Yeah, you may not love everything I tell you. Nobody loves everything I tell them, you know? But
Moreover, we are blunt.
but that's part of life, right? If we're sitting down and you go, hey Matt, you're looking really skinny today, I'm gonna be like, you're full of shit, you know. Let's be honest with each other and practice that, right? And we're gonna get along just fine, right? The best professionals are truthful.
Yeah.
And I will hammer that one home all the time, right? You, as a consumer, be aware. As a client, be aware. The moment someone makes you feel uneasy, you do not have to work with them anymore. We have survival instincts, right? Use them, right? Research, research the person you're working with. Follow them on social media. See their consistency, right? There's a little trick in mortgage agent licenses, by the way. And I'm, make some enemies here. So my license goes M009, right? Your
2009.
license goes what, M024?
Yeah.
That's those
That's the
first
year.
3 letters are the year in which that license was earned, right? That will tell you about the experience level of the agent, right? If you see an M0222324, ask who's teaching them. Ask who's guiding them. Ask who's helping them. It's not rude. They should be proud to tell you who's mentoring them. They should be excited to tell you what they're learning, right? Here's the thing. New agents are amazing agents. And I'm gonna take a moment here and toot all the level ones and and young agents out there your horns a little bit. I'm gonna celebrate you guys, because here's the one thing that you have that I don't have: energy. You've got more bandwidth for clientele. You can give higher levels of service because you have less people to service at any given time, right? You're more hungry and ambitious. You're going to work harder for your clients than some of us old guys, right? Young agents have advantages, huge advantages, right? They're going to fight for every single deal that comes in their pipeline, right? Sometimes us old guys get, it's another one, right? You want someone who's hungry for your business. So young agents come with advantages. They may not know how to solve every problem, and that's fine. There's typically an old geezer behind them with all the answers, helping them through, right? So, that's what you're looking for in the perfect scenario, is some young, hungry person supported by some knowledgeable old fellow, you'll have a good relationship that way,
Okay. So
Awesome.
yeah, these were my questions. Everything
Good,
related to
good.
pre-approvals.
Well, there you go, Raul.
I hope this added value to all our audience. Like, I think like they can make the best decisions after watching this one, like what they exactly need to do, and yeah, everything.
Exactly.
And if you're someone watching till the end, please feel free to book a call from the link in the description.
Yep.
We can help you with all your mortgage needs or any needs that is in your home purchase journey.
Amazing. Thank you, and we'll catch you on the next one.
Yeah.
Thank you so much for watching the video till the end. If you feel it has provided any value, please support my channel by liking this video, click the subscribe button and ring the bell icon in order not to miss any of my latest updates.